just to qualify on that, if you have done a complete set, okay, then you're actually not doing your financial statements under IAS 34. Okay, you're doing them under IAS 1, just a complete set of statements. But if you're going to go and do quarterlies the way most of you have, where it just kind of covers off the quarterly information, then you need to say it's under IAS 34, because that's kind of where that applies. So the first statement you're going to come to is your statement of financial position. And I'm sure a lot of you have heard this current versus non-current. And, we all put the current first and then non-current second. That's how everyone does it right now. And is that still allowable under IFRS? And the answer, I would expect that most of you would continue to do that going forward. What it says is that you can put it in the order of liquidity if that provides more relevant and reliable information. So if you feel that the user, if it makes more sense to the user, if you put your long-term assets up at the top and sort of flip the whole thing upside down, then you can go ahead and do that. But for the average junior company, I would expect that you probably just continue to do it the way you do it, current and then non-current. A couple quick points. Deferred tax assets and liabilities, they'll always be shown as non-current. Minority interest is now called non-controlling interest. Just see how you'll see in the literature. Information regarding the number of shares. For any of you who've done any 20Fs or US things, you always had to put the number of shares that are authorized and issued. You had to put that right on the face of the balance sheet. And so what it's saying under IFRS is you can do that, or you can put it in the note. Generally, under Canadian, you won't see that right up front on the balance sheet, but you can put that up if you feel that's warranted. Last item, Pristine In Statements that you need to say. I just put an example of a line, and you see this. At the bottom of your balance sheet, you have two directors that sign. This will be right above that. And this is just an example, but authorized and approved by the board of directors, and you've put the date. Okay? Normally that date would correspond with the audit report date as well. That whole, we're going to talk about subsequent events and that sort of towards the end, but that whole, it's kind of happened under Canadian GAAP already, but that whole timeline between when you have that audit committee meeting and when you actually release those statements and all that, and the approval of the statements and so on, so they've really tried to tighten that up as much as possible. So it'd be a bit of a challenge to get all that done, but that's the direction it is. So, but you do need to state this somewhere in the statements, usually on the face of the balance sheet, or the statement of financial position. Statement of comprehensive income and loss. If you have looked at some IFRS financials, you may have noticed that the order that the statements are in varies, and so we have seen sometimes we'll put this statement right up front. Generally, though, that's if you have an operating company where you have revenues and profit and that sort of thing. And really, the point is that you might feel that that's very useful to the user to see up front your revenues and all that sort of thing. Again, for a junior exploration, if you're just sort of raising money and spending on exploration and so on, putting the statement of financial position up front makes more sense in that case. Order of the items, nature versus function. Probably no change here. Most of you, we do sort of nature right now, the nature of the expenditures, and that would continue. And then under IFRS, there's no extraordinary items anymore. But just consider it, if it can happen once, it can happen again, and therefore it's not extraordinary. So this is a new statement. Of course, all of you have this in the notes somewhere, but it's required now under IFRS to have an actual statement of changes in equity in your financial statements. It just can't be in the notes anymore. So probably going to go with the same sort of disclosure as the one you can do already. Break it down, you'll have share capital, you'll have reserves, you'll have your retained earnings or deficit. The term reserve is basically replacing contributed surplus. So that's the new term that you'll see. That was made up of share-based payments or stock-based compensation, warrants, foreign currency translation, and available for sale of financial assets. Changes there. Statement of cash flow. You know, cash is cash, and there really isn't a lot of change here. The one item that has been discussed a fair bit, and you may have heard it, is whether or not, or we're going to switch from going from the indirect method to the direct method. We haven't seen anything to say that that is in fact the case. Who knows, maybe that's coming down the road, but for now, you can continue to do the indirect method, and it's completely acceptable. So really just status quo on this one. So the notes of the financial statements. In general, there's more notes. And I think a lot of you already knew that, but that really is the truth. So there's just going to be more notes, and you'll see as we sort of go through where that comes from. Nature and continuous of operations, so note 1. We've got 4 things listed here. Really the one that would stand out as being very different from what we do now is you need to state the address of your head office. Probably asking why, and I don't have an answer for you, but it does state that that needs to be in there. So that's kind of a different item for you. As I mentioned before, you're going to need a complete list of your significant accounting policies. Okay, you're going to need that in all of your quarterlies for 2011, fiscal 2011, and then into your annuals. You won't need it in the next quarter, as I mentioned, because you'll pay back off your annuals, which will be under IFRS. But for the next 3 quarters, your first 3 quarters, you'll need to put that in there, which is obviously going to make your quarterly quite a bit thicker already. Last point, generally you need a note for almost every line item on your balance sheet, your statement of financial position. For example, receivables. Generally, you have your receivables and you have your amount and leave it at that. But you need to have a note in there breaking out the different kinds of receivables that you have. Now, that being said, let's say you have prepaids, which is another line item, and it's just a nominal amount, then it doesn't really make a lot of sense to have a note for it. But the idea is that for receivables, for prepaids, for AP, items which you didn't generally have notes for, under IFRS you do need to put those in general. It just depends. If it's a nominal amount, then you won't need to, but for the most part, they're looking for much more disclosure on those items. Erez is going to take it from here to talk about the IFRS transition.
Okay, so the IFRS transitional, so this portion is just to give you an overview of what that IFRS reconciliation is going to look like in your, let's say, March 31st, 2011 quarterly. And this is the part where it kind of comes a little bit of the bad news. And I don't mean bad news, but you're going to see that it's going to be a pretty lengthy note. So sort of take a deep breath and realize that your quarterly one is going to be probably about 5 to 6 pages, a little bit longer than it was before. Before that, when you do adopt IFRS for the first time, because there's certain sections out there that IFRS accounting will result in significant differences. So there's what they call exemptions. And exemptions are sections, accounting sections, that you can either choose to go back in time and restate under IFRS, or you can just do it prospectively. So for example, if you enter into a business combination, which is one of the more significant differences between IFRS and Canadian GAAP, you can account for business combinations only going forward. That's a big one. Another big one is oil and gas and stock-based compensation. So this is a list of the sections you can just do going forward. So the reconciliation. So now I'm the CFO or control of our company, and March 31st has passed by, and let's say I have that 30-day extension, so in theory I've got until June 30th to complete my first quarterly. And you're sitting there and it's around June 27th, and you're thinking, well, I better get going on this quarterly. I'm just going to open my March 31st, 2010 quarterly and piggyback off of it, and it'll be easy. Well, unfortunately, or fortunately, depends on how you look at it, you're going to have to provide quite a few reconciliations at that point in time. So even if you have just one difference, okay, even if your mineral properties are stated differently, even if your stock-based compensation is stated differently under IFRS, or deferred tax acts, or whatever it might be, you have to provide the following reconciliations. One is going to be as of January 1st, 2010. Okay, this is again assuming you have a December year end. So if you've got a March year end, just take those dates and bump it up 3 months. So assets, liabilities, and equity as of 3 points in time. Okay, so January 1st, March 31st, and December 31st. So that literally means, and I'll show that in the next slide. You can't see it there, but you can see in your hand, that literally means you have to produce a balance sheet under Canadian GAAP, and then you've got an adjustment column, and then you've got your IFRS column. Okay, so that's just one period. So that would be, let's say, January, or that's December 31st, 2010. So going back to that, you have to show it at those 3 separate points. And the reason why that is because, well, December 31st, 2010, you're going to be presenting it on your balance sheet. January 1st, 2010 is because that's your transition date. And then March 31st, 2010, because that's your comparative period. And you're going to need that in order to perform the cash flows or the income statements. Okay, and the same thing's just going to be for the loss and comprehensive loss schedule, i.e. your income statement. And the same thing is going to be for your cash flows. And if you've had significant differences in your equity section, then you would also have to show that reconciliation for your equity. So if you're a company, and I'll take a typical junior mining company who had FIT liabilities booked and they had stock-based compensation, and it's different. Let's say you just had those 2 adjustments. Effectively, you need 5 things like that, on your interim financial statement. So and even if you've only got really 1 adjustment. So the issue with that is that your first quarter is going to be a lot of work. Now, once you do your second quarter and your third quarterly, you would have already gotten used to it by then. But when you really visualize that March 31st, 2011 is a lot of work. And we speak to counterparts in Australia and Europe, etc. And for years they've been telling us, when are you adopting IFRS? And then we say, well, 2011. They say, oh boy, that's going to be quite a year for you. And up until probably about 6 months ago, we said, nah, it'll be fine. And yeah, there's a few adjustments, maybe a little more, but it's not that bad. But of course, as we get closer to it, we all start to realize, well, maybe your numbers aren't going to be that different, but if you just have that one little adjustment, you have to reconcile that for all these periods. So, and as Dan mentioned, IFRS can be different everywhere around the world. Australia's got what they're calling Australian equivalent to IFRS, and Europe's got the European Union equivalent to IFRS, and Canada only has IFRS, but I bet you 3 years down the road, we'll figure out that we're the only country in the world who really does a lot of flow-through financing, and so we'll probably end up calling it Canadian IFRS. And so it's going to be different everywhere, but the one thing time after time that we have seen, whether it be in Australia or European Union, is that. And that's those nasty 5-page reconciliations that you'll have to do. So, and that really drives home the point of why you can't sit there on June 27th and go, well, I better start my quarterly, I'll just look at last quarterly beforehand. So that's really the main driver of that. So expect in your quarter 1, 2, and 3 to have all of these tables. Now, if you do end up in a situation where you have absolutely no differences between IFRS and Canadian GAAP, then you could consider shrinking that down and just qualitatively stating that. And you could also consider just reconciling from current assets or current liabilities, etc. We have found that this presentation allows the reader to most clearly be able to compare IFRS and Canadian GAAP. There's on the next slide just an example of the income statement or the statement of comprehensive loss. And we didn't include the cash flows either, but effectively you'll need about 6 or 7 of those. And then after you did that part, then you got to talk about it. Well, you got to explain why you had a deferred income tax liability difference and why stock-based compensation is now $1 million rather than $200,000. So underneath the tables, there's going to have to be a paragraph for each adjustment. All right, so again, increased amount of work. And back to Dan. So now we're going to go through the actual adjustments under IFRS. So these are, for this crowd, what we view as being the accounts that are going to most significantly affect companies in Vancouver. So back to you.
Just saying one point just to add also on those reconciliations. We had up there, 3 financial positions, 2 statement of operations and 2 cash flows. But for the cash flows, if there really aren't that many changes, and you don't feel that it's really going to add any value to the user, you can get away without putting those reconciliations in. You can just make a sentence or 2 about them to say that there really weren't any differences in